I feel like I've internalized the benefit of conferences since I talk about solar so much, and spent 4 days in Las Vegas last year for that one. Very curious about the viewer numbers and whether people are kind of trickling in, or if it all kind of jumps up at the beginning. We're gonna give everybody a couple of minutes to find their way in before we get started. Peter, I was in Chicago, and by the way, as people are coming in, feel free to say hi in the comments. We'll see your names if you're logged in, and I know we have a lot of familiar faces who show up at these things. So always good to see where everybody's from and who they are. Peter, I forget if I mentioned I was in Chicago over the summer, just passing through. Yeah. I did the kind of Midwest turn. I'm smitten by Chicago. I feel like going to Chicago in the mild part of the summer and fall is a way to get convinced that you should just move there right away.
It's a pretty city.
Yeah. We were also bringing a 10-year-old who's just kind of super into sports and big buildings and the kind of stuff like Chicago does, like the pier very well, and the museums. It was a good time.
Yeah.
Do we have a count up timer? We do have still learning the StreamYard interface. We'll give people maybe another 45 seconds, and then we can start chatting. I see the numbers kind of ticking up as we go. Always fun to see where people are coming from. We've got a few viewers on StreamYard. We've got a few coming in from Twitter/X, some from YouTube. I said this when there were only a few people in the stream, but would love for people to put in the chat where you are from. If you want to put down, who you are and what you're doing, that'd be helpful too, since this topic is especially relevant to startup founders, but does apply to small business owners and employees and investors as well. It's always helpful to know kind of who we're talking to. All right. 2:02 on the East Coast. We'll give it 10 more seconds, and then we can kick it off. I'm indexing the number of viewers I see that we have compared to what we expect. I don't want to jump the gun, but we can get started. So welcome everyone to, I don't know if this is the 5th or 6th webinar in our new series. We've spoken so far about charitable remainder trusts, about capital gains in general, about estate tax, specific estate tax strategies, solar and ordinary income tax. Today, we're drilling down even further on what I think of as a subtopic within the capital gains category. We're talking about QSBS, or the Qualified Small Business Stock Exemption. If you're here, then you very likely at least know what QSBS is. We'll of course be going into some depth about the strategy and the benefit, and then some strategies to extend it. We've both been on these calls before, and I see a lot of familiar names, but just to refresh, I'm Jeff. I'm part of Valur's founding team. Nominally, day-to-day, I run product here. I'm a lawyer by background, and so tend to take the lead on diving into some of these topics. And here with me is Peter Tucci, also a lawyer and our head of estate planning. Estate, of course, overlaps pretty significantly with QSBS planning. So the two of us will be getting into some of the nitty gritty and using our technical background as well as our experience now, having done a ton of these QSBS oriented vehicles to dive in. So the agenda, like I said, we're going to be starting out talking at a high level about the QSBS exemption. What is it? What are the mechanics? How do you make sure that you take advantage of the bare minimum? Are you qualified? And if so, how do you make sure that you're not paying taxes on that first bit of capital gain? We're also going to be talking and spending a lot of time on strategies to extend the QSBS benefit. Everyone who qualifies, and we'll talk about what that means, gets a $10 million exemption, but you can do better. And you can do better via a variety of strategies, some involving trusts, some involving gifting, to stack those QSBS benefits, to multiply them. And we'll talk about that. We'll do a little case study to show you the potential kind of quantified benefit of pursuing some of those strategies. And of course, we'll always leave time for Q&A. We tend to answer questions throughout. So if you have one, just put it in the chat. We'll answer those as we go, or if they're bigger, maybe we'll save them for the end, but don't hesitate. Don't wait until the end. Just chime in with questions as they arise. So what is QSBS? The Qualified Small Business Stock Exemption, also called 1202, which is named for the provision within the Internal Revenue Code where it resides. The headline really says it all. This is dollar for dollar the best tax break around for startup founders, early employees, small business owners, and investors. And the reason we can say that is that it's one of the very few 100% tax deductions or benefits in the code, and it applies to a very large amount. The first $10 million per company you've invested in or gotten shares from, or 10 times your investment. Though in practice, it's fairly rare to get above that $10 million number. But what you're getting out of this is you're paying zero federal tax on $10 million of capital gain from an eligible company, as well as zero state tax in 45 states. Unfortunately, California happens to be one where that doesn't apply. And I know a lot of you are from California. We'll talk about that. But in general, you're paying zero tax on the capital gains from the sale of a business or from shares in the business. And that's just massive. So who are we talking to today? Well, the concept here is that when you sell shares in a qualifying business, you're going to pay zero tax. So the question is, who tends to have shares in a qualifying business? We'll talk about the details, but in general, businesses qualify for QSBS if they're organized as a U.S. C corporation, if they've been around and you've held shares for 5 years, and if they meet a few other qualifications. So, and it's a $10 million benefit. So anyone who owns shares and plans to sell shares in one of those qualifying businesses is going to be a fit for general QSBS planning. So startup founders are the most common user of this benefit. And that's really why QSBS was written into the code. It was a feature of the kind of 90s US government obsession with spurring startup growth. So startup founders, the number one user for this sort of thing. Small business owners who have decided to organize as a C Corp. Early employees, we'll talk about what it means to be early. And then investors as well. Really anyone who owns shares in these businesses and plans to sell them at some point can be a fit for this strategy writ large. Just to kind of show some social proof here, we often get asked, we're talking with clients, prospective clients about this stuff. We often get asked, it's great that this exists. Is it a loophole? Is it the kind of thing that the IRS doesn't like? Is it the kind of thing that you're kind of pushing me into and it's not kind of really used broadly? We always like to point to very public and large cases of people taking advantage of these strategies just to demonstrate that they're public, they're known, they're writ large, and they're usable. And so we've talked in the past about how Phil Knight uses charitable remainder trusts to offset the gains from his Nike stock. We've talked about kind of the Waltons being of Walmart fame being a huge and famous user of the GRAT strategy. Here, a famous use case of QSBS and specifically QSBS stacking, which we'll get to talking about, is the founder of Roblox. He and his family claimed the $10 million QSBS exemption. Of course, there's no reason not to if you're eligible. But he also used some of the strategies that we're going to be talking about today to multiply his and his family's QSBS exclusion, at least from the public records, as far as we can tell, 12 times over, meaning that he and his family wrote off $120 million of gains from the sale of Roblox shares, which saved them probably somewhere in the range of $30 or $40 million. Very publicly, and so that's, I think, some helpful evidence that this is a mainstream strategy that really any one of you and your clients can pursue. We're going to get to the strategies for multiplying, but really first we want to level set and talk about the baseline, thinking about who this is for and who can take advantage. We're going to walk through relatively quickly the requirements and limitations for qualifying. So Peter, you want to take the handoff?
Thanks, Jeff. So there's a few requirements. Not every business is going to qualify. So first, the taxpayer has to have received shares directly from the company. This is the original issue requirement. There's a few pieces to this, but basically, if let's say a founder sells his shares to someone else, those shares probably won't qualify. But if the founder was issued shares directly by the company, or an employee, or an early investor in the company, those shares will likely qualify under the original issue requirement. And there's sort of a sub-requirement here, which is that the business has to be a small business, which is the aggregate assets have to be under 50 million at the time of the stock issuance. So Google, for example, Google shares could never qualify under this rule, at least not for 30 or 40 years.
Peter, what does that sizing rule mean for example, a venture-backed startup, which I think is a lot of the clients that we talk to and who are here today? How do we assess whether a startup is going to be eligible under that $50 million rule?
Yeah, so basically, it's the actual assets on hand. So like IP, physical assets. It's highly unlikely that a startup before at least like Series C or something would have $50 million of assets. So most startups won't be tripped up by that requirement.
And so that means
there's other issues that could trip up startups, which we're going to talk about a little further down the slide.
But so the founder of a startup who took their shares at the beginning, any early employee of a startup who joined at seed, Series A, even probably Series B, is typically
and the early investors as well. Right. Yeah. Then there's a 5-year holding period. So what this is you have to have held the shares for 5 years at the time of the sale. So if you're a founder and you got the shares in 2018 and you sold them in 2024, you'd qualify because you would have held the shares for 6 years. But if you got the shares in 2020 and you sold them today, you'd be short of the 5-year holding period. So there's also ways, which is sort of beyond this discussion, but there's ways of rolling over QSBS shares that haven't quite qualified for that 5-year holding period. There's ways of rolling the shares over into other investments and then sort of tacking on the holding period onto the new investment. But in general, you have to have held the shares for 5 years at the time of the sale. And then there's requirements for the company itself. So the company has to be a C Corp. It doesn't necessarily have to start out as a C Corp. Sometimes businesses start out as LLCs or something else, and then they convert into C Corps later. In the event of a conversion, the 5-year requirement begins when the company becomes a C Corp. So if you held an LLC for 5 years and then converted it to a C Corp at the last second, that wouldn't work. And then it has to be an active business. So if you have a C Corp that is just sort of holding index funds or something, that's not an active business. So that's not going to qualify. But if you have an actual business, like a startup that's producing some sort of software or something, that's going to be an active business that'll qualify. And then the second thing is the qualified trader business. So this is sort of the most restrictive part of the rule. So basically, the sort of simple way of thinking about this is software companies are going to qualify for QSBS almost always, but sort of more traditional old line companies, like a real estate business or a banking or insurance business is likely not going to qualify under the rules. The rules themselves are a little bit complicated, but basically they exclude lots and lots of types like service businesses, real estate, hotels, stuff like that. So you're basically left with mostly technology companies, which is really the original idea of the tax break was to help encourage the creation and growth of technology companies. So that's sort of how it works.
Peter, we have a question. I see Mike. Mike, it's good to see your name again. Been a regular attendee here. Before we answer this one, I just want to ask, kind of broadly speaking, shifts from one type of entity to another, moving to a C Corp, totally fine. As Peter mentioned, when the 5-year clock starts when you convert, as do a few other kind of important triggering factors. But yes, in general, you can move things around and become a C Corp, and then the QSBS requirements kind of start on that day. To Mike's specific question here, can you change an S Corp to a C Corp? Does the employee have to be full or part-time? In general, yes, you can convert. An S Corp is a species of an LLC. You can convert to a C Corp. If it's a single employee S Corp, in general, that factor doesn't really change much. There's this active business requirement. It doesn't really depend on whether the person in it is full or part-time. With that said, in our experience, we get this question a decent amount. We have people coming in asking about their personal S Corp, and they being the only owner, or maybe it's them and a spouse. Usually those businesses tend to get tripped up on the qualified trade or business requirement because they tend to be the kinds of old line service businesses that Peter mentioned. So back when I was a lawyer, I had an S Corp. I was under my own name, and it would have been great if I could have sold my practice and converted to a C Corp and sold my practice. That wouldn't have qualified because I wouldn't have been a qualified trade or business. So the basic answer is yes, you can convert. And no, it doesn't really matter whether kind of how many employees you have, who's working full time, but you need to focus on that qualified trade or business requirement. Peter, is that a fair characterization?
Yeah, that's right. And then there's this 80% of assets in the U.S. That's very few companies get tripped up over that, but basically they want it to be a U.S. based business. And then the state tax rules are interesting. So basically 45 states conform to the federal rules for QSBS, which means, if you have, if you're based in New York and you sell your QSBS eligible business, not only do you avoid federal taxes, but because New York conforms to the federal QSBS rules, you also avoid New York taxes. So it's super powerful. But there are 5 states that don't conform, and a few of those states are pretty significant states. So California doesn't conform. So if you sell a company in California, you're still going to avoid federal taxes, which is huge. Federal capital gains taxes are 20%. Then there's a 3.8% surtax on net investment income. So avoiding the federal taxes is super significant. But you're still going to be paying California income tax if you're a California resident. New Jersey similarly doesn't conform. Pennsylvania doesn't conform, and then Alabama and Mississippi don't conform.
But in practice, as I think you can all guess, where this becomes most relevant is we've all got clients in California and New Jersey and a little bit of Pennsylvania, and it's just worth noting early on that this is not going to apply to their state tax. There are other things you can do with that state tax, and if you're interested, you can reach out to Valur and we can talk to you about them. But this is going to apply only to the federal tax for those clients. So with all of that in mind, we do want to talk a little bit about the kind of practical how it works. This is really very simple. If you qualify, then you're going to have access to this benefit. How can you make sure you qualify? Well, you can tick through those boxes. You can ask your business lawyer or your accountant for a general view on whether you qualify. Ultimately, especially for larger companies, it's very common to obtain a QSBS attestation letter, which is essentially a letter describing the results of a study that an accounting firm has done. verifying that the company is eligible for QSBS. So for example, when a company reaches, let's say, Series C or D and is maybe nearing a potential exit, it's very common for the company to engage an accounting firm to get a study done and a letter that says this company's shares are eligible for QSBS, and any shares that were issued up to X date were eligible. After that date, new shares become ineligible because the company had more than 50 million of assets, for example. And so most big companies will, as they're nearing an exit, will issue that letter to all employees, and it'll say, if you got shares before this date, you're going to be eligible for QSBS. If you're a smaller business, there are lighter weight ways to do this. You can engage an accounting firm to do a more informal study just to make sure that you haven't tripped over any of the rules. Those studies can be, mildly expensive the bigger the company gets. A very large company might pay, mid 5 figures or more for that. For small companies, that doesn't make much sense if you're a small business. So you might engage an accountant on an hourly basis just to do this kind of work. We don't do that in-house at Valur, but we do have partners who do. So if you need the help, we can certainly point you in the right direction. Quick note, Amar asked about a copy of the presentation. Yep, you're going to get a recording of the whole thing if you're here. So no worries there. The last step in claiming this basic QSBS benefit is really very straightforward. It's just a tax deduction that you claim when you file your return, just like any other. And so all you need to do is make sure you're aware that you're eligible, and then work with an accountant to file your taxes who knows about this and can do it correctly. Ultimately, there's no special extra filing. There's nothing you have to register for to get this benefit. There's no extra vehicles just to get the basic 10 million. All you have to do is claim it when you file your taxes in the year following your sale of taxes. Last little note here, just practically speaking, we're going to talk about QSBS stacking next. But just practically speaking, talking about when this becomes relevant for people, certainly when you're selling your small business, or if you're a founder selling your company, this is obviously going to be relevant to you. But there are some more hidden times when it's relevant. For example, if a founder or early employee is taking secondaries after the 5-year mark, right? Valur's been around. I've owned my shares for about 4 years now. If we have secondaries after a year from now, even if we're not selling the whole company, I'll want to look into QSBS, right? Basically, anytime you're selling eligible shares, whether it's secondaries or a private sale or an IPO, anytime you're selling eligible shares, this is relevant, and you should be thinking about how to make sure that you're claiming the benefits. With all of that basic groundwork in mind, we've talked about how you are eligible for and claim the basic $10 million QSBS exemption. The next logical step, and where Valur tends to come in helping clients with this, is asking, how can we do better? How can we go beyond that basic $10 million exclusion? Peter's going to talk through a couple of vehicles that are relevant here. You can see up on the screen, non-grantor trusts and charitable remainder trusts. But just to lay the groundwork, the idea here is that the QSBS $10 million exemption is written into the code in a way that applies to every individual shareholder who has received eligible shares. Peter talked through those requirements, the main one relevant here being the original issue requirement. If I get shares as the founder of a company and I give them to my kids or my cousins or my friends, they remain originally issued shares, and that person also gets to claim a $10 million exemption. Also importantly, and that doesn't work if you sell the shares, as Peter said at the outset, but if you gift them, then the recipient gets their own exemption. Also, very importantly, individual shareholders are defined here to include entities. And so you can give your shares to a trust, and that trust will get its own $10 million exemption. Now, there are a few different types of trusts that apply here, and they have their own kind of mechanics and pros and cons. So let's talk through a couple of those. Peter, if you want to.
Yeah. So There's a bunch of different types of ways you can stack, but there's a few basic common vehicles. And so probably the most common is what's known as a non-grantor trust. So a non-grantor trust is a type of trust that's a separate taxpayer for income tax purposes. A lot of trusts, probably the majority of trusts in the US, are not separate taxpayers at all. They're actually disregarded for income tax purposes. So, like for example, like a living trust, revocable trust, that's not a separate taxpayer, so it's not going to get its own QSBS exclusion. Um, an intentionally defective grantor trust or a grantor retained annuity trust, those are not going to be their own taxpayers, and so those are just treated as the same as the individual grantor of the trust. So they're not going to get their own additional QSBS exclusions beyond what the grantor gets. But non-grantor trusts are separate taxpayers. They pay their own taxes, so they get their own QSBS exclusions. And the sort of big picture idea is that let's say you have two kids, you could set up a non-grantor trust for kid one and a second non-grantor trust for kid two, and each of those trusts would be separate taxpayers, and so they would each get their own QSBS exclusions. And so if you had $30 million of stock in your QSBS eligible business, you could gift $10 million of stock to trust one and $10 million of stock to trust two, and then you'd get your own $10 million QSBS exclusion, and each of those trusts would get their own $10 million exclusions. And so you'd actually be able to exclude all $30 million of gain on the sale.
Peter, you've been using the word taxpayer, and I slipped up and used the word shareholder, and that's an important kind of distinction. The general question is, who can be the beneficiary of these sorts of gifts and get their own QSBS exemption? Can it be literally anyone, or are there limitations?
Yeah, so it has to be a taxpayer who's separate from the grantor, and so there's a lot of situations where people think, I have a living trust or something, and I have some shares in there, then I have some shares in my own name. Can I get two separate QSBS exclusions? And the answer is that they have to be a separate taxpayer. So a non-grantor trust is a great vehicle, partly for that reason. The other neat thing about a non-grantor trust is that if you live in one of the states that doesn't conform to the QSBS rules at the state level, like California, for example, or New Jersey, you can actually gift shares to a non-grantor trust that resides in a state that's not California or New Jersey. So, for example, you can set up a non-grantor trust in a state like South Dakota, give shares to it, even if you're a Californian. Those shares are going to be owned by essentially a South Dakota resident trust. And so, when the South Dakota trust sells those shares, it's going to be treated like a South Dakotan selling the shares. And so you don't have to worry about California income tax on those shares. And then another common type of trust that we see for QSBS stacking purposes is called a charitable remainder trust. Sort of the big picture is that a charitable remainder trust is a type of trust where a non-charitable beneficiary, so an individual, usually the grantor themselves, is the beneficiary during a set term. The term is usually either a term of years, up to 20 years, or the grantor's lifetime. But in practice, for this sort of a trust, it's usually a much shorter time period, like 5 or 7 years. And so you set up a charitable remainder trust for, let's say, 5 years. You get distributions each year, at the end of each year, from the trust. And then at the end of the term, whatever's left over in the trust goes to charity. Typically, it's 10% of the initial funding amount roughly goes to charity. That's the minimum amount that you can do while still qualifying as a charitable remainder trust. But the idea is, you're giving away some amount to charity. You're also getting an upfront charitable deduction. But importantly, you're getting the big QSBS tax break that you wouldn't have otherwise gotten on those shares. And so if you put, $5 million of stock into the charitable remainder trust, you're going to end up getting around $4.5 million back, and you're also going to be you're getting an upfront deduction. So basically you're getting $4.5 million of shares back plus about a $250,000 tax benefits. So it's a pretty it's a pretty powerful tool versus just doing nothing and paying the in this example $1.5 million of tax.
And that's right. And so there are these are two vehicles. They, at a high level, unsurprisingly to most people, seem pretty similar. I think it's worth drawing out the major distinctions here between these two types of trusts. A non-grantor trust, as Peter described it well, involves giving shares to someone else, and they get the trust on their behalf, gets the benefit, which means that you, as the person with the shares originally, are giving them away, right? They're no longer yours. Typically, you're giving them to one of your kids, sometimes other family members, but you're giving them away. And so this is a vehicle that is typically used by people to set up their kids or another family member with shares. Of course, there are ways to benefit from your kids having more money down the road, but ultimately you lose control of those shares. So it's a huge benefit. You get to keep all the money in the family, but you're giving it away. A CRT, by contrast, because the ultimate beneficiary is you yourself, you get to keep the money. The trade-off is you're keeping a little bit less of it. You're giving some of it to charity. You're still paying a little bit of tax for a variety of esoteric reasons. So a non-grantor trust is going to have slightly higher returns, but you have to give the shares away. A CRT is going to have slightly lower returns, but you get the money back. The other major difference here is timing. A non-grantor trust you can do really any time, and in fact, the earlier the better. With a non-grantor trust, you're giving the shares away to someone else, and so you are using up some of your lifetime gift tax exemption, estate tax exemption, by giving the shares away. So if you give them away when they're worth $10 million, you're giving up $10 million of that exemption. I'm sure you all are at least basically familiar with the gift exemption. That's a big chunk of your lifetime giving. By contrast, if you do this in the early days of your company when the shares are only worth $1 million, then you're only using up $1 million of your lifetime giving, and that's a big benefit. So non-grantor trusts you typically set up well in advance. You still are welcome to set them up, farther down the road, even right near the time when you're going to exit. But there's more flexibility, I guess, is the point, in when you set up a non-grantor trust. A charitable remainder trust, for a variety of reasons that are beyond the scope here, is going to have to be set up in the weeks or probably even days before you close your sale. That timing can be fraught and can be challenging if you don't have full control over the transaction. And so CRTs are a little bit tougher to implement in this context. We've done a lot of them. We get it done. It's a little bit tougher. So it's worth looking at both. They have pros and cons. One reason that CRTs are even doable, and a major kind of value add on Valur's part, is whether you're doing a non-grantor trust or a charitable remainder trust, or any of the dozens of other trusts that we have for other purposes. We've built systems to get these things done very quickly. If you had hired a traditional lawyer to do this, it would have taken weeks or probably months to get these vehicles in place. Then you've got to get the assets transferred. It's a hassle. It takes time. You got to work with the company's lawyers. Valur can set these up in 24 hours. And we do so, by the way, for free. So the timing and the cost should never be a barrier to entry for anyone or their clients. You should be exploring these things and assuming we can get it done. With that said, the earlier you make contact, the better. It's always good to have the full panoply of options available to you, but we can always help. So never think it's too late, never think it's too expensive. Valur can almost certainly help. Peter, a couple of questions here on the technical side that I think are worth answering. The first, I guess, let me answer, or one of us can answer Mike's question, which is, I think, pretty straightforward. The payment from a CRT is taxed as ordinary income or long-term capital gain. I guess, Peter, you want to take that one on?
Yeah. So that's a good question. So in general, the income that's being distributed out of a charitable remainder trust is taxed the same way that it would have been without the charitable remainder trust. So if it's treated as long-term capital gain inside of the charitable remainder trust, then it's treated as long-term capital gain when it's distributed. In this case, there's the gains excluded, and so you wouldn't be paying tax on the distributions. The distributions would be non-tax, like the income itself is excluded income, and so there's no income to tax. But in general, a charitable remainder trust, the distributions are treated the same way as the income would have been in the hands of an ordinary person.
Yeah, the way I think about it is that the trust is never going to kind of penalize you. You're going to keep the treatment, and if the treatment is favorable, you're going to get it. And so, as Peter said here, if the shares are QSBS eligible because they went into the trust, then when they come out, they're going to be QSBS eligible. You're not going to pay tax, and that's a big part of this benefit. You put 10 million of shares into a CRT, and you take those distributions over the years. Basically, 10 million, not quite 10 million, is going to come out completely tax free. That's the big benefit. Other question here is Stevens, and this is a kind of a technical legal question. Peter, are you comfortable?
Yeah. So the statute says each taxpayer gets their own exclusion. There's no beneficial ownership rules. I think those would have to have been written in the statute if they wanted to impose those. So, for example, if you set up a non-grantor trust, it files its own tax returns, it pays its own taxes, and so if you let's say you gave $10 million of stock to your daughter and $10 million of stock to a trust for the benefit of your daughter, the non-grantor, assuming that the trust is a non-grantor trust, the trust could never make distributions to your daughter, and the trust could just pay its own taxes every year. Your daughter could also pay her own taxes every year. It's clear that your daughter and the trust, although your daughter's a beneficiary, it's clear that they're not the same person for income tax purposes. They're not the same taxpayer. And so I think it'd be pretty surprising if the IRS, for example, issued regulations saying that they're going to treat two different taxpayers as a single taxpayer for these purposes. I think they'd have to pass new legislation to do that. But there's not a lot of case law in general on QSBS, not just on this question, but on anything, because the rules are relatively new. So basically, the modern version of QSBS was enacted in 2010, and people first started claiming it essentially in 2015 because of the 5-year holding period. And so it hasn't been around for that long, and there hasn't really been a lot of cases on it. And the IRS never issued regulations like connected to the statute. And so really all we have to go off of is the statute. But the statute says each taxpayer gets their own exclusion. So that's sort of the consensus that people have been using.
That's right. So the bottom line is there are a couple of vehicles that are valid here that our clients pursue that are doable. As you're exploring this for yourself or with your clients, we encourage you to reach out. Really, anyone who has a company that has kind of gotten its legs under it should start thinking about whether it makes sense to pursue one of these vehicles or one of these stacking approaches. And certainly, once you have an eye on the exit, even if it's a year away, even if you haven't even started shopping around or talking to anyone, it's worth getting in touch to talk about whether this is going to be relevant to you and your clients. So that's the bottom line pitch here: is never too early. Get in touch and let's discuss whether it's a fit. Last thing we want to do here with kind of 5-ish minutes left, and feel free to keep chiming in with questions, but just wanted to look at the magnitude of the potential returns here. So this is a case study that's based on our own proprietary models, which you have access to on our site. If you go to app.valur.com, maybe Guido, if you want to put the link up, app.valur.com, you can go to one of our many tax calculators, including this one that helps you understand the potential benefit of QSBS stacking. So the study that we looked at here is a startup founder, although that's not super relevant. This is a person with a large amount of shares in a company, lives in New York City. The shares are QSBS eligible. And we assume here that prior to the sale, in fact, a few years prior, this founder gifts her shares to 3 separate trusts, non-grantor trusts specifically, one for each child, as well as one CRT, a charitable remainder trust, for herself. So 4 separate trusts. So what does she get? Well, you always get, and let's assume that the shares sell for 50 million. So she owns 1/5 of the shares. The CRT owns 1/5 of the shares, and each of the 3 trusts owns 1/5 of the shares. She always is going to get her own $10 million exemption, whether she does any planning or not, right? So she's going to sell 10 million in New York City, totally tax-free. She's going to avoid probably about 36% tax on those shares. With the other trusts, if she didn't do any planning with the remaining 40 million, she'd owe tax on that amount, right? It's above the 10 million. She's selling 50 million total. So on the remaining 40, she would owe probably about 35, 36% in New York City, which would add up to something like $15 million of tax. If instead she parcels it out to all of these trusts, each trust gets its own $10 million exemption. And as a result, all $50 million, at least in theory, could be completely free of federal and state tax. So instead of paying probably about 15 million of taxes on the $50 million gain and keeping 35 million and then reinvesting it, and we assume you reinvest at an 8% annual rate, instead of keeping 35 and reinvesting it and having it grow, as you can see here, to about 47 after 5 years, instead she gets to take 50 million and not pay any tax and reinvest that full 50 million. Over 5 years, that grows to maybe something like 67. Minus, that 67 already has taken out of it that little bit of charitable gift from the charitable remainder trust. A couple of important things to note here. First of all, that's a lot more money for this founder and her family, right? An extra $20 million after taxes just 5 years later. Importantly, 30 million plus growth of that money is with trusts for her children, right? She's not getting access to that money directly. She's given it away. So if you or a client who's doing this really values holding on to the value of these shares, then the non-grantor trust strategy might not be a fit. Maybe it's just the 10 million for themselves plus a CRT where they get the benefits back. In fact, we're working with a client literally right now to finish up a QSBS stacking CRT. He's going to reap about 45 million of gains from his sale. And he ultimately decided he was not interested in giving the shares to a non-grantor trust for his kids. He wanted to keep control of all the money. That's fine. So he's getting a $10 million exemption himself and an extra 10 million via a CRT. This founder is very happy to give 10 million each to the 3 kids. There's a lot of nuance to how that money can be invested and spent. It doesn't have to go to the kids immediately. That's a big benefit of using a trust here. But ultimately it's going to those trusts. I guess, Peter, just in 30 seconds, do you want to talk about how you can kind of direct and use that money in the non-grantor trusts?
Yeah, so the non-grantor trusts, you're not going to be a beneficiary. Typically, the way these are set up, they're usually for the benefit of loved ones like children. And so you can use the money to, the money can be invested in things that you want to invest in. There's no real investment restrictions on a non-grantor trust. And so, if you want to invest the money in in index funds, you can do that. If you want to invest the money in real estate, you can do that. If you want to invest the money in, crypto or whatever, you can do that. What you can't do, unless you pay for it, is you can't just use the money for yourself. So you can't just buy yourself a house and live in the house unless you pay rent, in which case that's fine as long as you're paying for it. But you can't treat the property as your own property.
And Peter, that's all really helpful. And then thinking about kind of who the money is going to, a big benefit of these trusts, right, is that you have some control over when and how the money goes to the beneficiaries, right?
Yeah, so the trust can be structured so that, so typically you wouldn't be the trustee, you'd have someone else's trustee, but you can name someone you trust, your brother, whoever, to act as trustee. And so you can rely on them to make appropriate decisions about distributions, not making huge distributions to your kids when they're 18. But also you can include terms in the trust to prevent distributions that you wouldn't have agreed with if they'd happened on your watch. So there's a few things there, and sort of the bigger picture idea is that with a non-grantor trust, you're actually getting assets out of your estate, so it's a huge estate tax savings as well. This chart only shows the income tax savings, but there's a huge estate tax savings here. So in this example, the $67 million, around 41 million have been transferred to the non-grantor trust. So that's 41 million that's not going to be subject to estate tax when you die. It would otherwise, in this example, there'd be about $20 million of estate tax on that $41 million of stock inside of or investments inside of those 3 non-grantor trusts. And here she's avoiding not only that income tax, but also all of that estate tax as well.
That's right. Sorry, Peter, I jumped the gun with that slide. So just wanted to get here before people start dropping off. We're just about at time. Hope this has been helpful. The bottom line is there are a number of vehicles that you can use for this specific purpose. You've got access to us, to our expert team. You should use it. You can always schedule a call directly on our site or at this link, valur.com/schedule. You can email me or Peter directly. You can also email support@valur.com. And our model really in general is we really want to talk to you, whether you're a person who's selling shares or an advisor or CPA with a client who's doing so. We think a 30-minute call is going to move the ball forward pretty significantly. And that's really where we add a ton of value and can help people kind of decide if this is worth pursuing. So strongly encourage you to schedule something if this is relevant to you. We also just very briefly help with all manner of tax situations, not just QSBS. As many of you know, I can see a bunch of repeat names here, but we help with ordinary income tax planning, with other capital gains that are not QSBS eligible. And as Peter was alluding to right there, estate tax as well. So if you or your clients earn more than, let's say, $300,000 a year, if you have a capital gain that's going to be, $500,000 or more when you sell, if you've got an estate that's worth more than, let's say, $5-ish million right now, or you expect it to be worth more than 10 million in your lifetime, it's worth getting in touch, and we can start talking about the potential ways that you can significantly reduce your taxes. I see that there's still a couple of questions trickling in. We'll stick around. Obviously, nobody else has to, but we've got a few more minutes. So Brian asks, is there a way to avoid state income tax with QSBS stacking assets held in a trust in South Dakota? Peter, you want to do that one?
Yeah. So So if you transfer shares, so let's say you're a California resident, and so you're in a state that doesn't conform to the QSBS rules. And remember, the only states that don't conform are California, New Jersey, Pennsylvania, Mississippi, and Alabama. And so if you're in one of the other 45 states, you're going to be able to avoid state income tax anyways, just by virtue of the state conforming to the federal QSBS rules. But if you are in one of those 5 states that doesn't conform to the federal rules, then it depends what you're trying to do. The obvious thing would be to gift the shares to a non-grantor trust in a state that doesn't have income tax, and then the trust would sell the shares and not have any state income tax.
And so the practical use for that sort of move is we've talked to folks in the past who live in California. Their kids are in California. They're making a good amount of money, but they're not maybe doing stacking. If they're doing stacking, then a trust could make sense anyway. And you can move it out of California. But even if you've only got a $10 million gain, you may want to give $1 million to a trust for your kids, and then you'd be avoiding a 13% California tax on that amount. So that move can make sense even if you don't have a huge gain. It's an especially clear kind of no-brainer if you're doing stacking, in which case you'd be doing a non-grantor trust anyway, and avoiding the state tax as well. I guess. Any last substantive questions? I see people kind of saying thanks and signing off, and we're over time. Mike asked, just to verify, the QSBS does not work for service industry companies like hotels, restaurants, laundromats. I think that's a fair summary of.
Yeah, that's almost always the case. That doesn't qualify. So like maybe if you had like a digital, like if it was software for a laundromat, then maybe it would work. But an actual laundromat is almost certainly not going to qualify.
Yeah, that's an interesting question, though. Whether something that just has a bunch of machines and they're governed by a scheduling system and there's no humans involved, that's a little bit beyond the scope here. But for the most part, what this rule is trying to capture is brick and mortar, servicey, or kind of service economy, lawyers, consultants, banking, these sorts of things are not covered. If you have any question, if it's not totally clear, get in touch. Let's dig into it. We'll bring in our partners who do validations, and we'll figure it out for you. All right. I guess with that, join us next time, a week from today, right before Halloween. We're going to be talking about oil and gas well investment. This is the last remaining way to offset your personal and business ordinary income in 2024, given the late date. So yeah, check it out. Also check out our YouTube channel where we show all of this stuff after the fact if you didn't catch it live. So thanks everyone for joining, and we'll talk to you next time.